Hi guys. This is welcome to Investing with you. Okay, today we'll discuss a mining company called Nevsun Resources, and I first was introduced to this idea in last year in July-ish um, by Sven Carlin. So if you wanna check out, this is his page. So if you wanna check out his videos, I highly recommend it. So yeah, let's take a look. But I did some more. He did like I think something like a 15-minute video on it. Gave the high level idea, and so I dug a bit deeper into it, so you can see how essentially see how I do these research, and also uh, so that you can pick apart the way I think about things and tell me how I'm wrong. Now, first, just some history that I did with Nevsun. I started buying somewhere here. I think that's when I got exposed to it. I bought 6 lots. The last lot I bought was very luckily at the bottom of the entire thing at 202. I think it was I bought at 203 or something. That was the last lot I bought. So so it's made me a decent a return since then. Um, the market cap when I bought it was at less than $700 million. Something around yeah, it was something like less than $700. And back then they had $25 million in cash. I think that's around here. That's when I last checked. After that, I kind of just bought and kept on buying. Um, and if you look at their numbers now, their market cap has gone up from around 700 to 800, and their enterprise value you can see is still below that. So basically, they have net cash, and that's the same as what I. Uh, they actually got more cash compared to when I bought it. In terms of PB, this is I wouldn't look at PB too much. It's for mining companies, especially for projects that they bought. So they didn't actually make the discovery. They bought this project off some guys. So it's always very iffy to determine whether they paid a fair price to it or not. So yeah, and you can see they're losing money at the moment. But for this kind of company, I kind of focus on their asset, not too much on their current earning, because a lot of this will happen in the future. The earning, a lot of that will happen in the future, but not future as in I don't even know how they're gonna make money kind of future, but like really simple business model. They dig up some shit from the ground and sell it kind of in the future. So in terms of assets, we have some account receivable and prepaid. So these guys, I mean, this is the latest report, right? So cash is cash. Account receivables and inventory, these are fairly decent assets. Inventory, because this is copper. So your copper, my copper is all the same thing. That's a nice thing about a commodity producer. This is rarely a case of um, inventory write down unless your commodity happen to go down in price. It's very different compared to, let's say, GoPro, where all of a sudden they may have to discount their cameras to sell. Account receivable and prepaids is a fairly small portion, but I've never heard of them taking a write down on these, so I wouldn't worry. They have some more inventory, but for somehow they kind of put it as non-current, i.e., they're not going to sell it within a year. So probably some kind of milled stuff that's sitting somewhere. And then they have this mine. This stuff will get depreciated over time, especially their producing mine, as the Bisha mine. And then obviously the equipment will get depreciated. So mine properties, you can see this is reducing from 2017 to 2016. Over a year, they reduced the mine properties and plant equipment by like less than $20 million. they increased their cash or their current asset for more than for about $25 million. Actually, this is not a year. This is 3 months, right? Okay, and they have some current liability. These are all obviously true. You have to pay them. They stopped paying a dividend, so there's no longer here. And then they have to pay income tax and whatnot. And so non-current, they have some income taxes they have to pay. So these are obviously real, and they have to reclaim the mines. So that's obviously real too. So the Bisha mine, basically. So overall, comes out, if they were able to convert this consistently into cash, then I wouldn't really worry about this. Plus, they have enough cash, more than enough cash to cover their total liabilities. Okay, so that's that. And then let's first look at their producing mine. So they hold a producing mine. It's called Bisha. And Bisha is in Eritrea. It's in essentially Ethiopia, north of Ethiopia. What they don't own 100% of this. I think they own a large portion of this, and the other portion is owned by the Eritrean government. And you can see their production, their projected production. And what happened was they had some issue with Bisha in 2016 and 17, where the recovery rate for copper and zinc was almost like a seesaw. When they drove up the copper recovery rate, zinc dropped, and vice versa. So basically, it's metallurgy. I'm not sure if I'm pronouncing this correctly. Problems. They were able to fix that last quarter. So if you look at last quarter, did they discuss? Okay, fail. Let's see. Last quarter, they had, I remember they had a good quarter. Yes. Yeah, they discussed that. Their recovery went from 8% to 81%, and simultaneously their copper recovery went from 34 to 61. So that's all very nice, which meant that they were able to generate about a $25 million in cash from Bisha. Now, you can see the projected production is going to be, 2019 is going to be similar to 2018, and 2020 and 21 is going to go down. So 25 million, 4 years. If we only count 2 years, then you're looking at $200 million. So we can probably add $200 million. By 2020, they should have $200 million from Bisha. And that's an underestimate. Okay, so you say, okay, but it's $200 million. It doesn't justify their what? Doesn't justify their $700 million enterprise value, right? Because or market cap. This thing reduced by $200 million is still not enough. It's $600 million. What do I get for the additional $600 million? And that's where I think the beauty comes in. So you got Bisha mine, which is the ugly duckling, actually. And then they have this gigantic Timok stuff. So I was looking at this, I looked into this Timok stuff, right? So it basically it's in Serbia, and it's in the Bor district. And I checked out here. So this is the biggest, I'm not sure if this Timok is the other Timok, but it was supposed to be in this area, and this is the largest mining company, the headquarters of the largest mining company in Serbia. And they have a shit ton of mines, about like 7 operating mines or something. I think I saw them. Yeah, so Bore mine is in Bore, which is operated by that. This one is there. I think there was another 3 that was also operated by the same company. So what is nice is, oops, there will be a lot of infrastructure ready for Nevsun to use, for this Timok project to use, the milling, the smelting, and the transport, because you don't use that much copper, right? So you need to transport this stuff. So you could either go to, I think they were going through Montenegro, or you could go through the Black Sea. Either way, these are historical routes. People have been using them forever, so there's no risk for that. And the other nice thing is the Serbian government. Well, let's first look at the big picture. Sorry about that. I was digressing, but the big thing is Timok has a $1.8 billion NPV at 8%, assuming a $3.15 copper and $1,300 gold. This is really high, and you can see this is much higher than the $800 million market cap, or as we calculated, the $600 million EV enterprise value in 2020. Assuming they only get $200 million out of Bisha. What is NPV? NPV is net present value. So what you do is so first of all, it's negative. It's going to be like you spend the money, construct the mine, right? It takes like 2 years to make the mine, 2 to 3 years. So that's negative, negative, negative. And every year into the future, you would discount those by 8%. So if it's negative, I'm not sure if the negative part also goes down by 8% or goes up by 8%. But either way, it's going to be 3 years of construction, and then you start actually mining, and you can sell these ores or concentrates in this case, and that money will be discounted 8% per year, right? So why we do this? Because $1 now is better than $1 next year. So this is saying that if you expect an 8% annual return, you should pay $1.8 billion for this project as soon as they start construction and all that stuff. I think it also accounts for the permitting costs and all that. But you see my point. This is already accounting in the growth in terms of like almost like an interest rate you're expecting. And you look at this grade, it's insane, 3.3%. You think, oh, what does that mean? That means in a ton of ore, you get 33 kilos of copper and 2.1 grams of gold. Well, where do these lie? 2.1% gold is a high-grade gold deposit on its own. Not to mention you got 3.3% copper. And to compare, the average I had something open. Let me just close these things. Blah, 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 blah. The average grade, I remember, actually deteriorated quite a bit. Yeah, here. So this is a paper that I found in 2016. They were trying to determine like the average grade. So copper went down. Where are we? To here. You can see the global average copper ore grade for copper mines is approximately 0.62% of copper. Now you see why that grade, that 3%, is crazy. It's 5 times the average grade. Okay, they say $1.8 billion. Let's just do a back of envelope calculation to make sure that how much are these ores actually worth on their own? So 27 million tons times So these are a million tons, right? So we take out the million. Everything is in millions. 0.033 for the copper plus 27 million tons times 2.1 gold, right? So that is copper. Copper per ton. Let me just get that. Sorry. Excuse me. Excuse me. Ooh. Blah, blah, blah. Copper price. Yay. I want to do metric ton. Okay. So 6,000. Whoops. So multiplied by 6,777. That's copper. This ounce is 1,309 or something, current gold price. So you're looking at $80 billion worth of metal. Obviously, you have to extract them. So let's subtract the extraction cost. Typically, this is going to be an underground mine. Right? This is going to be underground mine. So typically, they cost about $100 per ton milled. So let's just subtract by 100 times 27. So everything is in minute, right? So you're looking at 77. This number looks crazy. 77 billion, but in quite a bit into the future, though. So this gives you an idea of how much money there is. Obviously, once you take into the account of you have to first spend the money, right? You have to spend the capital expenditure, and for the mine construction and all that stuff, it will go down. But the mine construction is fairly cheap. Their mine construction is estimated to be less than $600 million. And you can see here you have some crazy 16% copper. Holy crap. I have never seen another mine with this kind of grade for copper. This is insanity. Anyways, so they're using this sub-level caving, and they say typical. Yes, it's gonna be a sub-level caving is fairly typical. I saw a video on YouTube.
Sub-level caving is a large-scale mining method suitable for large ore bodies with a steep dip and a rock mass where the host rock in the hanging wall will fracture under controlled conditions.
You can see they
Therefore,
just make these
the
tunnels
infrastructure is always placed on the footwall side. Mining starts at the top of the ore.
Anyway, you can watch this yourself. Just search for sub-level caving. It's quite interesting. It's made by this Atlas Copco company, which makes mining equipments. So they're saying they're less than $20 per ton mined. Remember when I said $100, $100 per ton milled. So once you mine it, you have to mill them, and if you like get them out of the way out to the market. So this is how they're gonna do the sub-level caving. The ore is large enough, and here's something. They expect high copper recovery but fairly low gold recovery. So that is a lot of where the previous number is going to change. So instead of this entire thing, you have to then multiply by 0.93 for the recovery, and then multiply by 0.32 for the recovery. Yeah, otherwise, yeah. To account for the recovery, and then you have to minus the 100 times 27. So $26 billion. Yeah, the low gold recovery is cut down the value by a lot. And the other thing is here, arsenic grade. So this is something I realized recently, that there's an article talking about it actually. So it's saying copper miners grapple with arsenic problem, net flow of dirty copper pushing up treatment cost. So it turns out not all copper is the same. The copper mines can have like contaminants, or people, I think the actual name is called deleterious elements or something. So that stuff makes smelting and refining much more expensive. So people have to pay a penalty for that. And also it says most smelters will not process material containing more than 0.5% arsenic. Okay, so essentially there needs to be some kind of down blending. If your thing has a high arsenic percent, you have to downgrade it. So this part I'm not entirely sure whether this is going to be part of the copper concentrate. Like, are they going to extract the arsenic concentrate and send it out, or is it going to, that 1.4% is going to be in the actual concentrate? So if it's 1.4%, then they need to buy some clean copper concentrate and blend them so that it conforms to the 0.5% cutoff. So that I don't know, but we'll see. And you can see the actual construction is going to be at 2020, and then 2022 is production, and obviously there might be a delay, so maybe at 2023. And then the capital cost is fairly cheap. They're looking at less than $600 million in initial capital expenditure, and they've already spent. They have already spent a lot of money, and then they need to spend 114 more before they can start the entire construction. And yeah, here's the number. Milled is $100 per ton. And then they do talk about, oh yeah, the arsenic grade is 1.4, so they do need to find some kind of clean copper to blend it with. Then they talk about penalties. I'm guessing this penalty applies because of the arsenic. Anyway, so this is how their capital flow is going to look like. As you can see, as I described previously, you first spend money before you start making money. And the nice thing about Timok at the upper zone is that the production is pushed to the beginning of the mine. So the mine very quickly dies off, but most of that comes at the beginning. So we like that because there's a cost to capital, right? The faster we get it back, the better. So they have some insane IRR, internal rate of returns, like something like, it's like 80% or something. It's pretty crazy. Yeah, 80% IRR. And here you see they are fairly large within the undeveloped mines. They're, you know, mid-size, I would say, not too small, and not the biggest either. IRR is insane. Initial capex is on the low side, so that's always nice. So what that helps you is if your initial capital expenditure has to be funded by equity dilution, then obviously we, as shareholders, we lose out. If it's funded by a large amount of debt, then typically the debt terms will be really bad. So you will get very high interest rate and have a bunch of restrictions. In this case, remember we said they already have $100-something million in their bank, plus another $200 million by the time they start the whole construction. You're looking at close to like $350 or more in their bank. So they only need to borrow $300 million ish. So that suddenly becomes a lot more appetizing to lenders. I mean, the simple example is if you think about, let's say, 50% down payment. Essentially, they can put down a 50% down payment and that's really nice for lenders. So that's nice. So we got something that's worth $1.8 billion. Actually, that might be an underestimate. So let's see. I forgot about this. Let's do that. Per pound. Sorry. We should do this per pound. Actually, that's about right. Yeah. So depending, obviously, that's going to depend on the copper price and gold price. So they slightly, in their estimate, the gold is slightly less expensive and copper slightly more expensive, but we'll see. I will discuss the copper demand and supply and demand situation in a later video, but that's definitely going to be part of this the logic behind investing in this company. So this is how they look like. You can see this is what we just talked about, and here is the freebie, the lower zone. So what they did was upper zone's $1.8 billion. They also own 60%, soon to be reduced to 40%. Why 40%? They have some weird joint venture agreement with Freeport McMoran. Freeport is one of the larger copper mining companies. It's like $1 billion plus company. Yeah, $21 billion company. So they have a shit ton of money, and they're really large. So the lower zone, as you can see, is much bigger in size, and it's actually very deep. I read about it. They have they estimate this thing's like close to 1,000 meters wide and like 3,000 meters long, and potentially hundreds of meters in depth. Now, the obvious problem is you probably can't do an open pit mining because it's so deep. You can see the upper zone is here. That is already an underground mine. So you might have to do an underground mine for this guy. And because the grade is much lower, there's about 1%, it's a large porphyry deposit, instead of this guy, which is a massive sulfide deposit. So these are smaller but much higher grade stuff, and this is a larger, but it's large enough. And yeah, you can see this thing is 2 kilometers, 1.1 kilometers wide and 1.4 kilometers deep. It's crazy large. We don't have an exact number, but I think, did they talk about the resource? Did they talk about the resource? No, there's no size yet, but imagine, we compute the wow, I'm not gonna compute the size, too much work, but it's gonna be worth a lot of money. The only problem is that you might have to do an underground mine here, which is potentially a bit annoying and increase the cost. So if copper price increases, this will be worth a ton. It's like a free call option on copper. Okay, so yeah, so what we have is we're basically buying this company for the upper zone. We have a cash producing mine, Bisha, that will just supply almost half of the capital expenditure needed for the upper zone. And then we have 40% almost free thing, a freebie, that is essentially a call option on copper price. And so yeah, and then also we're getting this upper zone at less than half off. When I bought it, it was like 2/3 off, because back then it was like $600 million in terms of enterprise value, but now it's about 700 something, but still very cheap compared to the actual value. Now the risks are mining problems, but this doesn't seem very complex. The entire blob is very close together, so it's not like I don't know if you ever show this for what do you call that, McRiver. Yeah, I think it's called McRiver. The chemical uranium mine, that stuff is twisted all over the place. And so there's no water on top. It's all nice things. It's in solid ground, so that I don't think is going to be a large risk. In terms of infrastructure, there's no risk. It's all over the place. It's a historic mining district. And in terms of regulation, I actually found this thing, Serbia energy thing. Serbia seemed to like energy quite a lot. They're fairly proud of their mining history, and then this is a mining district as well. There's a ton of copper mines, and there could be a delay. In fact, there was already a delay for the exploration decline permit, because I think they were just Nevsun was just not very good at getting the permits. And then financing. So even with Bisha, you will be looking at $200 to $300 million of extra funding that's needed. So that's another risk. Given all these risks, I think I will still take the 33 cents on the dollar plus some free shit around. It's always nice. All right, we'll probably discuss the copper market itself in the next video, since it kind of ties into this one. So if you like, please subscribe and click like and leave comments if you have something to say. See you next time.